Hey everybody, how you doing? John and Forrest here for another monthly market update. We feel like it's been a little while since the last one. We were a bit delayed. September back to school with the kids and all that kind of stuff. So,
and what a back to school it was.
What a back to school it was, yeah. So we're all in the swing of things now. There's been some big changes in the real estate climate lately that we're going to kind of run over. Of course, we want to say thanks for watching. Really appreciate it. You may have noticed this month that it's a slightly different format. So we've kind of redesigned how we're doing things and kind of doing more like a monthly newsletter. So there's some more clickable things in there. We're going to put some links to some interesting news articles and stuff like that. And hopefully you guys like it. If there's anything you think we should add or take out, we'd really appreciate any feedback. And so just kind of jump in and get started.
Cool. So basically this month, we're going to cover a plethora of mortgage changes that came down the pipe, basically the last couple of weeks. Obviously, we're kind of getting close to an election somewhat here in Canada, a federal election, obviously provincially as well.
We're seeing mortgage changes.
So now we're seeing kind of mortgage changes to help younger people, first-time home buyers, because effectively the Liberals are fully aware that this election's not going to be an easy one for them.
Yeah.
So they're vote buying. So we're going to go over the three main changes that have happened, and they will affect you 100% if you're a buyer, especially if you're a first-time home buyer, a young buyer, or a new construction buyer.
Anybody that's planning to refinance a mortgage.
That is true. That is true. We should actually start with that one.
Let's do that.
We'll start with this one. This will affect everyone who owns a place with a mortgage on it, right? So the first thing is, going back to 2018, a stress test was introduced in January on all mortgages. So it basically meant that, hey, your mortgage rate's 3%, but we're going to qualify you at 5%. Or your mortgage rate's 4%, we're going to qualify you at 6%. It added 2% to the mortgage rate on the contract you were actually paying. And obviously, when you increase the mortgage interest rate, the amount you can borrow drops. Mm-hmm. This is what cooled the market massively in 2018.
Yeah, it cooled the market, and it just really held back the barrier for entry, right?
Basically, from overnight, you used to be able to borrow about 6 times your household income, and it dropped to about 4.5 times overnight. So it's a big difference, right? Mm-hmm. Obviously, that's been in place for 6+ years now, right? And we've got used to it. The issue was when you refinanced a mortgage. The stress test applied for refinances where you switch lenders. So for example, you were TD, you did your 5-year fixed. At the end of the 5 years, you were like, I want to shop around for a rate. Well, hey, you've got to now stress test. You've got to pass that stress test for all the other lenders that you could potentially go with. But if you stick with TD, you didn't have to, because you didn't have to requalify. So what it meant was people were getting renewal letters from their current lender, and effectively the rates were garbage.
Yeah, so they weren't able to shop it around.
Knowing full well that they had them over a barrel, because if they shopped around, some of them wouldn't want to deal with facing that stress test again.
So jobs change, situations change.
100%.
While they could still afford the mortgage, financially, it's just, with the new stress test, maybe they're on paper they couldn't. Right?
Or a lot of people just don't want to have to deal with the paperwork or the fear of getting rejected, or going through all the hassle of doing it and then finding out actually, I can't do it. I've got to stick with the same lender. People are busy, right? Mm-hmm. So a lot of people just renew with the same lender. So it's kind of freed up options for the consumer. It's good for everyone apart from the banks, I would say.
Yeah.
And it's worth mentioning as well that the banks lobbied, when the stress test came out, the banks lobbied the federal government to enforce stress tests on people changing lenders, because they knew that they could then jack up the rates for their existing clients. So it's kind of like a horrible situation, but now it's been reversed, which is a good thing. I think it's just good policy, and everyone across the board thinks it's good policy, better options to the consumer. So that is number one. Mm-hmm. Do you want to cover the price cap one?
Yes.
Next one?
Yeah. So basically what they've done now is, previously when you went to buy a property, and anything over $1 million, you needed 20% down, right? So with a housing market where most detached houses are already priced over $1 million, it was a big barrier for entry for people, harder to get into the market, etc. So I think it's as of December 15th, the two big changes are they're increasing the insured mortgages from 1 million to 1.5 million. So that's going to kind of affect your down payment significantly. So for example, if you'd previously bought a house that was $1.5 million, you would need a $300,000 down payment. Where now under the new rules, you're only going to need $125,000 down payment. So it's more than half less than you would actually need.
And that 125 is kind of comes from the fact that with the first 500k of purchasing, you have to put down 5%, and then anything between 500k to 1.5 million now, you have to put down 10%. So it's basically 25k plus the 100k on the next million. That's 125k. So yeah, you can buy a house that's 1.5 million with 125k down.
And there's pros and cons to it. Obviously, it's a great move to lower the barrier for entry into the market as a whole, but it does increase like long-term carrying costs of the mortgage as well. So obviously, you're going to be paying more over the long term.
And also, obviously, when you're high ratio, you're less than 20% down with any purchase. There is a mortgage insurance, which is massive. So I think on this is about 3.5% with a minimum down payment. So say you put down your 125 grand, you bought your $1.5 million house, your mortgage is not going to be 1.375 million. It's going to be probably 1.45 plus. Like, so i.e. you're just going to say goodbye to the majority of your down payment, and your equity stake in the home is going to be 3 or 4%.
Yeah, so it's not going to be a lot. So while it does let people get into these more average price houses easier, you're chewing up a lot of your down payment.
You are.
So I find that most people buying a $1.5 million house are going to have close to 20% annual.
How many people have we sold? Yeah, I mean, they're usually putting down more than 20, right? Because they're coming from another place where they increased equity and
they're getting
else,
some money from their parents, or they've leveled up a few places. So
exactly.
I do think it's going to be great for people that might have the income but not the ability to save. Like, they don't want to wait another 5 years to save another $100,000 or something.
Well, I also think as well, detached homes, especially where areas we work, $1.5 million with a suite is a very achievable price point. Obviously, if you're in Burnaby or Vancouver, it's not. But further out into the Fraser Valley and further out in the Tri-Cities and everything, it's possible to get a $1.5 million house with a suite. And obviously, I think that's where it's going to be a real win. Mm-hmm. You do get boosts for suite income. I mean, when you borrow money to buy a house with a suite, there is a boost if the home has a suite, because they project that rental income. So that, coupled with lower down payments, increased borrowing costs, if you qualify, I think it's the real win on that.
Yeah, I think it's going to be great overall. It's just going to have those people that really kind of stuck at the townhouse level that wanted to make the jump into detached. It's going to make it a lot easier for them in the short term.
Still going to qualify for the mortgage though.
Yeah.
So the income needed to do this at this max amount would be insane.
Yeah.
Okay. So the next thing is 30-year amortizations on all first-time home buyer purchases, high ratio or not. So historically, if you weren't high ratio, and when we say high ratio, it's less than 20% down. When we say low ratio, it's 20%. Or we say insured or uninsured, so insured is less than 20% down. Kind of interchangeable terms. But now, any first-time home buyer, 5% down, 10% down, doesn't matter what it is, can do a 30-year amortization if they're a first-time home buyer. So this is great. I think this is great because
it's great, yeah.
Oftentimes, especially in Vancouver and places like Toronto, where we're more like a tech stock market with boom bust, people aren't really relying on pay down as much as they are in the prairies, for example. So it's more about like getting in and then riding a wave up, increasing your equity and leveling up into the next place. So it's kind of a strategic thing. So now, being able to get in and have a lower payment, I think, is the real cool thing here.
Yeah, it's again lowering the barrier of entry for people. They're gonna have a lower payment, easier to get into something, and while they may not be paying their mortgage off as much in the short term, it's going to make it easier to level up the different styles of housing or price points.
Yeah, you go through a market boom, your townhouse, your condo goes up $100,000. You go, okay, cool. Got a couple $100,000 here. Maybe we can get into a slightly bigger place. It's good. It's inflationary though. It will push the housing market up in that low end for sure. We're just coming out of an inflation environment. You got to ask the question: is this good or not? I mean, I don't know. We'll see. So that's the first-time home buyer thing, but it also affects all new builds, whether you're a first-time home buyer or not. So if you're out there and you've had a couple of homes, if it's principal residence occupied, obviously not for investors. God forbid the government does anything for them.
No.
But if you are looking to, you're in a condo and you owned it for a few years, and you're looking to get into a new pre-sale townhome or pre-sale house or whatever, 30-year amortization, no problem at all, providing it's brand new. So overall, pretty good, I think, these policies. At the end of the day, I think it's vote buying.
Yeah, it's a bit of election pandering. I mean, they're always either trying to stimulate the economy, the housing economy, or collapse it. It seems it's either one or the other. There doesn't seem to be a lot of common sense approach to any of it
until election
time. So I'm really curious to see how this all next plays out. And, with the forecasted further interest rates drops that we're going to be seeing soon, I think it's probably going to stimulate the market a little bit. Certain segments still kind of feel a bit flat out there. It's kind of week by week. Things seem busy, then not busy. There's also not a ton of inventory, so...
I think the remainder of this year is kind of going to be pretty flat.
Yeah.
I do think, though, with a couple more cuts and potentially a 0.5 cut coming at the end of this month, there's kind of a bit of a coin flip between a 50 basis point cut or a 25 basis point cut coming at the end of October. And then obviously we have one in early December as well. Say we cut another 50 basis points or 75 basis points by the end of the year, we start to see, the 5-year fix under 4,
mm-hmm. which
we are already seeing for certain situations, but for every situation, it's like, whatever ratio you are, whatever amount you're borrowing, you can get under 4%, 3.79, 3.89, that kind of thing. I think once we see those rates come back, which mm-hmm. are kind of 2019 rates almost, I think we're probably going to see a bit of a rebound. And I think 2025 is looking like it could be a really good year.
Yeah, I think at the end of the day, it all kind of comes down to buyer confidence. And I think what
mm-hmm.
everyone's trying to do with these changes and the interest rates coming down is they're trying to spur a bit of they want the buyer confidence out there. They want people to know that they can get into the market easier, that they can pay a bit less, you know what I mean? And overall just make the entry barrier lower for everybody. Mm-hmm. So I do think all of this combined with the interest rate forecasting to be coming down is a great thing. And I think 2025 will be a good year.
Yeah, I think it will. At the end of the day, it's like, the Liberal government are probably just looking towards the kind of millennial base, people kind of our demographic that maybe aren't in the housing market that want to get in and feel shut out. It is vote buying. Some of these changes are probably great. Some of them are probably not going to be great in hindsight. If we go forward 5 years,
we can even see some changes to these changes. You never know.
That often is the case. But we'll see how it plays out. But yeah, we do have more cuts scheduled for the end of this month and early December. Mm-hmm. It's looking like it's not a case of whether they will or cut or not. It's now a case of how big is the cut going to be, which is great news. Inflation's way down to 2%, mm-hmm. which is the lowest it's been in God knows how long. So things are on the up, and I think next year is going to be great, but we are seeing a little bit more activity now in September compared to the summer, which is pretty normal. Mm-hmm. And I think it's going to be a decent fall, but a much better spring next year. Yeah, so we'll get back to you guys next month and give you a quick update of what we've seen. And as always, thank you so much for watching, and please do leave us some comments on the new format of how everything is. So thanks a lot, guys. See you next month. Bye.